as the markets go higher, and granted, this isn't for crypto, but there's a wealth effect that adds to inflation, right? So, I always tell people this is they say, well, if the stock market goes up, does it potentially add to inflation? And the concept is that if you look at your 401k and it was 200,000 yesterday, and let's just say it's 400,000 today, and you were kind of thinking about a new car or a new TV, you're much more likely to say, yeah, let me go buy that new car, new TV, because look at my 401k, it's up massively. And so that's the reason why the Fed is more focused on the stock market and wanting it to come down. But right now, they've lost that credibility.
At the Federal Open Market Committee meeting last week, the U.S. Central Bank decided to stop its tightening campaign but still hinted at 2 extra rate rises this year. Jay Powell, the Year Fed chair, is scheduled to testify before the House Financial Services Committee. His appearance will be keenly scrutinized for hints regarding his views on interest rates. The U.S.'s downturn on Tuesday came after a week in which the S&P had reached a technical bull market, which is defined as a 20% rally from its low, and has raised questions about the sustainability of the gains, which have been largely driven by gains for firms tied to artificial intelligence. Growing interest in AI, according to Thomas Matthews, senior markets economist at Capital Economics, won't be enough to prevent the S&P 500 from dropping if the U.S. economy has a recession later this year. Gareth Soloway expresses his opinions on the stock market, pointing out that the Fed is making every effort to bring the stock market down as high levels point towards inflation, but he also stated that the Fed has lost credibility. Soloway also discusses Bitcoin, the supreme digital asset, and makes comparisons between it and gold as well as silver. He also discusses the unemployment rate, increases in interest rates, and rising credit card debt. Consider liking, subscribing, and leaving comments as you watch.
From my perspective, is definitely Bitcoin's on that track to be that digital gold asset, and I think Ethereum is likely the silver kind of the crypto markets. And what's interesting about gold and silver, right? So gold is your pure play, where it's just a store of safety, inflation hedge, all that kind of stuff. And then Ethereum is like silver in that silver is more volatile than gold. So Bitcoin is less volatile and Ethereum is more volatile than Bitcoin. But also Ethereum has a use case, right? Bitcoin, there's, you don't really see a lot of stuff being built on top of that. So I think my guess is, and again, I could be wrong here, but my guess is the future is those two make up probably 80% plus of the overall market. And then you might have some of these other smaller coins kind of carving out their niches, but it's hard to know. I mean, and now we have the biggest news in the last week was that BlackRock filed for ETF, right? And so the question is, and I think the big question, we saw a little rally in crypto because of this, is does this mean because there's such a mega financial institution that they talked to Gary Gensler, and Gary Gensler might have said, hey, listen, yeah, Bitcoin isn't a security, so we're going to give you, the biggest financial institution, the green light. Because I think if you look at the stats, right, BlackRock's filed for like 75 ETFs. They've gotten approved on 74 of them, right? So they obviously have this kind of ability to kind of say, okay, if we're going to do this, the probabilities of success are very high, yet we've seen the SEC reject time and time again a spot ETF. So it's kind of interesting here. What I do want to show here, and I'm going to flip over to my screen here, is I do want to go over that gold chart. A lot of people have been asking me, do you still see gold breaking out this year? We've kind of see gold languishing here. And the one thing I would just point to, and this brings us over to the stock market side of things, is that gold is stalling here. But what we're seeing is there's a massive inflow of bullishness into the market. So in general, when you see stocks like Nvidia going to new all-time highs and things, in general, you see gold falling more because it's a safety hedge, right? It's people saying, hey, I don't want to be in gold because I want to be in risk assets where I'm going to make more than a few percent on a yearly basis, which is more along the lines of what you expect from gold. And so I find it fascinating, and it's the same sort of thought process that I had when we were trading at the lows on gold in 2022 and going back to 2021, and the markets were at their highs. You weren't seeing, and by the way, this is when the Fed was raising most aggressively, and generally gold reacts very negatively to hikes in interest rates. Gold was not breaking down outside of this kind of choppiness. It got to this low end and then started to rally back. So for me, when I look at the price action in gold, gold is staying stable while you're seeing risk assets aside from crypto rallying substantially. I think the NASDAQ now is year to date up something like 38%. I mean, a massive, massive move. And so to me, this is a very bullish sign for gold. It's telling me that you have sellers that are moving out of gold to move into risk assets, but there's definitely buyers there, thus price is not falling. We hear that they've raised interest rates by X percent, which has been huge. I mean, the velocity of the raise, I think, is the shocking part. From going from a quarter basis point to where we are above 5% is just massive. But then you look at how much excess liquidity there was in the system because of COVID. And then you look at, all right, wages have increased substantially, so people have more money. I do think, like you're saying, there are cracks emerging, right? So last Monday when we did the no-shill zone, we talked about the jobless claims from the previous week being 266,000. And that was the biggest jump since 2021 in people filing for unemployment. And what I was saying is last week to really watch the next number, because sometimes you get these outliers, the data changes this calculation and it changes the numbers. But what we saw last week was 262,000 filing for unemployment, just 4,000 people difference. And to me, that's now saying, okay, it's probably not an outlier. You're beginning to see the effects of people getting laid off and filing for unemployment. So that would be one thing. A couple other things I'm seeing here. U.S. delinquency rates on credit cards are now rising at their fastest pace since 2008, right? So now it's not at the level, right? So the rate of change is rising, right? That's what it's equal to, but you're not at those levels. In fact, I'm going to show my screen here. This is a David Lynn, courtesy of David Lynn. And let me just throw mine in here. So here's his tweet. And I by the way, if you don't follow him, he's awesome at his data. He's a great interviewer and so forth. So definitely look to follow him. But U.S. delinquency rates on credit cards now rising at their fastest pace since 2008, although still nowhere near 2008 levels. So here you have the drive higher is essentially at that same rate, but you're still far below. So what that tells me is that people are still able to do their thing, even though the delinquencies are rising substantially. And then this one's kind of interesting as well, which says credit card debt now at all-time highs. And the reason why this is important in terms of credit card debt is because at all-time highs, if people stop paying their credit cards, it's a bigger deal to banks, right? So, if you don't pay your credit card and you owe $10 to the bank, okay. But if you own $1,000 and there's a million people that owe $1,000, now it becomes a bigger issue. And being at all-time highs is definitely unsustainable in the long run. The other thing too to just mention as I flip back to charts is that I also read that bankruptcies are now at their highest level since, I believe, 2011. Now, it's not at 2008, 2009 levels, but you're seeing again this shift. So for me, at least as an investor in stocks, in gold, in crypto, it's kind of the yellow light. You're not seeing the red flashing like, holy cow, we're going down with the ship, but you're seeing like, okay, there is a change going on here. And then the bigger question to bring back too is whether or not does inflation go back to 2% or under for the Fed, or do they get themselves in a pickle where we stick at 3% and it makes it very hard for them to bail us out whenever that big downturn comes?
Since last year, the central bank has increased interest rates 10 times. The rate of tightening has increased at the highest rate since the early 1980s, pushing credit card rates to an all-time high. Even if the Fed has stopped raising rates, the overall impact is still significant, according to Ted Rossman, senior industry analyst at Bankrate. There is a clear link between most credit cards' variable rates and the Fed's benchmark. The primary rate rose along with the federal funds rate, and credit card rates did likewise. According to Rossman, the average credit card now charges a record 20.69%, which is over 5 percentage points higher than it did at the start of last year. The high credit card interest rates consumers are presently facing are not going anywhere anytime soon, according to Michelle Rennery, Vice President and Head of U.S. Research and Consulting at TransUnion. The skip indicates that interest rates may not climb again this month. Credit cards are one of the most expensive methods to borrow money from month to month due to sky-high interest rates, yet many Americans continue to accumulate ever-growing debt. According to bankruptcy research, even if amounts are greater, close to half of credit card users carry credit card debt from month to month. According to Greg McBride, chief financial analyst at Bankrate, paying off high-cost, variable rate debt is a top concern for people. Soloway also thinks that the recent BlackRock decision, which led to a bullish surge for Bitcoin days after the ETF spots were submitted, may be very optimistic for cryptocurrencies. Do you believe that the markets are now unconcerned with the Fed's decisions? Post your thoughts in the comment section below and let us know what you think. Don't forget to like, subscribe, and enable notifications. Thank you for watching.